Good morning, ladies and gentlemen, and welcome to MacroAce with your host Tony, going through the prep for the Bank of England rate decision. Don't forget to share with your fellow traders and friends if you found the information useful beforehand. I'm also the head financial analyst at FinancialJuice as well. So with the Bank of England, let's get into it then. So with the Bank of England, so what is it with the Bank of England rate? So it's the rate that the bank pays interest to commercial banks. And why is it important? So usually, and everyone should kind of know this by now, if you've been focusing on the rate hiking cycle, not just on from the Bank of England, but other central banks such as the Federal Reserve, you'll understand, you'll know that whenever you raise interest rates, that is to dampen the growth or in the economy or make sure that inflation doesn't get out of hand. And the same thing with growth as well. Okay, then if we And then the other points as well that whenever interest rates are lowered, that is to boost growth and consumer spending, or if the economy is facing troubles, and let's say that inflation is lower than the Bank of England's target of 2%, or any other central bank, usually then the central bank will take action to cut interest rates to try and boost spending and growth as well within the economy. So, of course, the expected rate hike of 25 basis points for the Bank of England today to 5.25% is what is expected from the Bank of England. And then other things that we need to be aware of course, when you're raising rates or lowering rates, that of course has an effect on loans, mortgages, credit, and etc. as well, and other things as well within the economy. So let's carry on then. So where is the economy at the moment? So unemployment is at 4% compared to the prior of the rate compared to the prior of 3.9. Unemployment change at 25.7k versus minus 13.6k. Then we also had seen the employment change, 102k versus prior of 250k. Inflation was at 7.9% compared to 8.7%. Core CPI data year on year was at 6.9% compared to 7.1%. Average weekly earnings year on year is at 6.9% compared to 6.5%. And Q1 GDP was at for 2022 was at 0.1% compared to 0%. And GDP year on year was at 0.2% compared to 0.6%. Services data to what we had seen today, actually this morning. So we know that with the services PMI data for the UK, it came in as expected for the final read of 51.5. That was as expected, so there's no change from the prior as well. Manufacturing PMI was at 45.3 compared to 45. And retail sales year on year was at minus 1% compared to minus 2.1%. And month to month retail sales was at 0.7% compared to 0.3%. So remember, all these indicators here that we're having a look at is just what the central bank would be looking at, what they would be looking at themselves as well when seeing how strong the economy is and whether or not they need to continue hiking rates, or maybe hike rates for longer than they would have expected, or take a pause, or decide to, or maybe start cutting rates instead. But overall, what we can see, so the key points for the central bank, okay, for the Bank of England, as is still with the other central banks, is the inflation figure. So with inflation being at 7.9% compared to 8.7% the prior, if we were comparing it to the forecast, there wasn't that much of a drop. It was, I believe, if the inflation rate for the UK, if I just bring it up here for you guys. So the forecast was 8.2% and the actual was 7.9%. So yes, there was a bit of a decline by 0.3%, but still for the central bank, they're still above their target of 2%. And they will only start to maybe pause rates and then see what happens when they feel that they've done enough tightening. And at the moment, they haven't. They haven't done enough tightening to warrant a pause or a pivot going to and then starting to do cuts instead. That's one point that we need to be aware of with inflation data in the UK. Then part of that being the wage prices as well within the UK too. If there is a continuation of an acceleration in how much employees are getting paid, then that's also going to have a knock-on effect on inflation too. So if employees are getting paid more, of course they have more spending that's available to them to buy the same amount of products or goods and services that are within the economy. Now, the only problem is that some central bankers and some economists will see when we cover the non-farm payrolls report and why the wage data is still very important when we look at the employment reports for any nation, particularly the US, is that inflation is the leader of wages. So if you have inflation that is higher than expected, what tends to happen, and this is quite nuanced and it's a bit difficult to understand, but what tends to happen is that the employees will say our standards of living have risen and we need to get paid more money in order to be able to survive and still be able to come into work and have to be able to live. So why is that the reason? The reason why some economists, a lot of economists say the inflation leads wage prices is because that you have the external factors that affect those businesses that are providing those goods and services. So let's say that import prices have become more expensive or the cost of manufacturing goods has become more expensive. That price spiral that would have occurred for those businesses takes time to be passed on to consumers. Depending on how severe that inflation is, that can either be passed on very, very quickly or it can take quite a long time. So that's what Fed's Goolsbee had mentioned that's what they had mentioned previously, not too long ago, about it's inflation that leads the wage prices rather than the other way around, which sounds confusing. Some of you may think that wage prices, if people have more spending power in their pockets, then if they are buying the same amount of goods and services within the economy, the demand, of course, is increasing and the supply dwindles faster. But then there are other factors you have to consider, the external factors that affect why those prices are high in the first place, and then why there is a need for consumers and employees or workers to say that they need a wage rise in order to combat the higher inflation that they're experiencing within the economy. So that sounds quite confusing, but something just to be aware of when we're looking at and discussing the average earnings data or the inflation data from any nation, particularly tomorrow with the US. But I thought I'd give you a bit of a nice little summary, something that's quite important to understand from the macroeconomic point of view, and when you're looking at how the markets could be affected. Usually, the way the markets are affected in the short term, if you're a day trader, if you do see inflation rising in any area, whether that be in wages or consumer spending or producer prices, then that leads to volatile market reactions where the currency could see an appreciation and the stock market or the futures, the stock indexes see a decline instead, because of the expectation that the central bank in the hiking cycle would continue, is more likely to raise rates or continue raising rates in the future. So what does that mean for us then? So let's kind of go through some of the other things too. Hello, Mbande says 25 base point will be negative GBP. Seems London traders are trying to get a jump on it. Well, yeah, the pound's been down quite a bit so far, particularly on the GBPJPY. If we look at we'll look at the currency strength chart. The strongest currency is still the Japanese yen, with the weakest being the pound. Actually, let me bring that up here for you. That's also something to be aware of. Right there. There we go. There we go. So Japanese yen, strongest currency, and GPY is the weakest. So yeah, as you know, as the expectation goes, you price in the data already, and you might be right. Yeah, the traders in London trying to get the London traders are trying to get the jump on it. Well, usually, whenever you get the rate that's as expected, then you don't really see that much of a market reaction unless the statement is different or has some surprises that are hidden or that appear within it. Anyway, we'll go through that in a bit later. We've got about 20 minutes left till we do the rate decision. So the previous Bank of England rate statement on June 22nd. Second round effect. What did they say last time round? They said second round effects on domestic wages and prices are likely to take longer to unwind than they did to emerge. CPI is expected to fall significantly this year, mostly due to energy prices. UK market rate expectations have risen more than for the US and Eurozone, reflecting market concerns and persistent inflation more than stronger growth. So again, the focus is still on inflation. Scale of recent inflation surprises justified a 50 basis point hike. Then from the comments then on what we'd seen last time from the Bank of England's Governor Bailey and others. So Dingra, who is the most dovish member now of the central bank. So remember, you had Tenrero who had left and has been replaced by Bank of England's Green. Instead, Dingra voted for no change last time round, is more or less expected to do the same thing today. Or that's what we're expecting today. She said that there are some promising signals that inflation should ease based on big fall in PPI. Bank of England's Pill said that second round effects are stronger in a tight labour market. Remember, you're talking about the wage price spiral, or the wage prices. Whenever they talk about second round effects from inflation, that's what they're referring to, or one of the things that they're referring to. Bank of England's Bailey said that data showed clear signs of persistence of inflation, and the economy turned out to be much more resilient, and we're not nearly done at the moment. Tenrero, of course, remember I said she has left, but still important to note what she has said in the past. She said that tightening already in the pipeline would be sufficient to bring inflation back to, and most likely below, the target of 2%. The more the Bank of England raises rates now, the sooner and faster the Bank of England will need to cut rates. So the sooner the Bank of England will need to pivot and go the opposite way. July 3rd, according to the Financial Times, they said that it was said that it would be a mistake for central bankers to assume inflation rates will automatically go back to pre-COVID levels, and I believe that meant that for Bank of England's Green, who had said that before. Bank of England's man said it is better to front-load rate policy moves, and Ramsden says if there is evidence of more persistent pressures, then further tightening monetary policy would be required, and the impact of bank rate increases are taking quite a bit longer to come through than expected. So the majority of the members from the Bank of England still understand that the inflation pressures within the UK are still strong, and are taking a little bit longer to bring down, if we're going to summarize what's said here. Barring a couple of members or now let's say one member who believes that inflation is going to have significant falls in the future. So this was the previous sentiment then before Tenrera had left. So you'd seen that Dingra was on the very dovish side of the spectrum from between hawks and doves and neutral, and the rest of the members were on the hawkish side. So there's still a strong need to raise rates. Now, what is the current sentiment? Here we go. So Megan Green, the new central bank member for the Bank of England, now is central on the, when it says neutral, so more or less understanding that there are fors and against, the pros and cons for raising rates. But if we're looking at the scale here, it's not really clear that there is a slight movement towards the dovish side, but not as strong as it was for Dinger last time round. So the ultra dovishness from the two voting members, now going to one, it's kind of been cut off. And now we're stuck with the hawkish members mostly, who are still taking the reins. So the vote is also very important today for the Bank of England. So what is expected for the vote, and what do I mean? So what I mean by the vote is how many members voted for a rate hike, how many voted for no change, and how many voted for a cut. Nobody's expected to vote for a cut. That would be a big downward surprise on the pound. For whatever reason, they decided to surprise the markets with that. Everyone else is expected to vote for a hike for 8 members, and one being Dinger, who's expected to vote for no change. Now, usually, if you do get one of the members in this scenario that votes for no change as well, particularly, let's say, Green, who's on the fence, or seems to be on the fence from this scale, then that could add some further downward pressure to the pound if she decides to vote for no change. But if the expectations aren't met in general, whichever way, whether it be all of them voting for a hike or not, then that's going to create more volatility, and that means that there is a bigger opportunity, potentially a bigger opportunity that's presented for day traders to jump on the back of that. All right, so let's carry on then. So investment bank and market views. So 22nd of June, Morgan Stanley expects the Bank of England to hike by 25 basis points in August and by 25 in September for a peak rate of 5.5%. BlackRock said that the more the Bank of England hikes rates, the more damage it's going to do for growth and the more damage it's going to do for the consumer. And that's going to show somewhere, and it will be in the earnings, according to head of MEA, Kareem Chedid at iShares Investment Strategy for BlackRock. Their market pricing was also very important too. 19th of July, after the inflation data had come out, traders eased their Bank of England bets after inflation. They see the peak now below 6%. And UK investors shunned the expectation for a 50 basis point hike from the Bank of England in August, and now seeing around 65% chance of a 25 in August compared to a 58% chance of a 50 basis point hike. Then July 24th, traders pair Bank of England hike bets, putting odds on a 6% peak at 50%. Ease some of the, let's say, is easing the expectations of where the Bank of England is expected to end up. But of course, for the pound, that's not a good thing. If the central bank starts to hike by smaller amounts and then goes to a pause, then traders will be speculating on that within the markets and pricing in where the central bank would end up. And if it's smaller, let's say that the next meeting they don't want to raise rates, or there's expectations that creep in through the headlines that they're not going to raise rates at the next meeting, then that puts some downward pressure on the pound because of where they had seen the previous peak rate. If they did see it at about 5.5%, let's say, for Morgan Stanley, and below the 6%, then below the 6% peak what they had originally seen, then that adds some more downward pressure. All right, so let's look at the previous live stream that we had done here for the Bank of England. So this is about 10 seconds away from the last data that we've seen, June 22nd. So what you'll notice is that, well, the Bank of England delivered a surprise 25 basis point, surprise 50 basis point hike. Okay, or let's say an extra 25 basis point hike than what was expected. And this is how the markets reacted. So the pound flew off of the data. One of the other reasons, other than it being a surprise 50 basis point hike, of course, if you have access to the deviation sheet, you'll be able to see the reason that was given for the market reaction. If I just bring that up here for you. Okay, so here we go. You should be able to see that here. Okay. So the main reason as to why the market reacted in the way, of course, first of all, it being surprised 50 basis point hike taken by the Bank of England. There was said that the scale of recent inflation surprises justified a 50 basis point hike, as what I said earlier on. But they did say the CPI is expected to fall significantly this year, mostly due to energy prices, which moderated the market reactions. Overall, it was a hawkish release with the surprise 50 basis point hike and the sentiment that it was warranted because of how inflation had surprised them recently. But then if I take that away, move that away, and we can see later on the market reaction doesn't last that long. So there we go. So you can see it wasn't it didn't last that long. So because of the expectation that inflation is going to fall, that they see inflation falling significantly, then the markets went the other way instead. If they had said that they still expect inflation to be stronger off of the last report that they had seen, then you could have seen a continuation of a move towards the upside for the pound. But it was moderated, and hence you had received this reaction here. Okay, so let's kind of go back. Okay, let's get out of this here. So now we've got about 10 minutes left. Okay, so let's close that. Here we go. So here's what we had. Let's go through now. What are we expecting then? Okay, let's have a little chit chat about that. Now, whenever there is a surprise rate decision, whether it'll be higher or lower than the forecast, in this circumstance, let's say they go with another 50 basis point hike, taking the rate to 5.5%. Okay, that would provide, again, that would be a surprise to the markets and could provide potential upside movement to the pound. Alongside it, if they say that inflation is still stronger than expected, remember, not just the figure is what we've got to look out for. We've also got to be mindful of the statement that comes with it too. Because like I said, the statement had moderated how strong the pound movement, how strong the pound had moved after the initial reaction. You did see it drop off not too long afterwards. So the statement also matters too. If they provide a more than hawkish than expected statement, let's say inflation is much stronger than expected and they need to do more work to contain it, or and if they see the economy is stronger than they expect it to be, with consumer spending and GDP growth also if they expect it to be stronger, that could also, that's also seen as more hawkish. So let me clarify hawkishness and dovishness. Hawkish means that the central bank feels they need to put downward pressure on an overheating economy, or make sure parts of the economy that are overheating don't overheat, so they're more hawkish, and hence there is a need to raise rates in order to bring that pressure down. The flip side is the dovishness side, where they want to support the economy or grow the economy. And those kind of comments where they feel that the economy is having an impact or a strong impact from the central bank raising its rates. So if they expect the economy to deteriorate at some point, or much more than they had expected it to be, let's say, or the flip side is, well, if they say that inflation is expected to continue falling down significantly, then that would add the dovish sentiment. That would be dovish and would add downward pressure to the pound. Okay, so more hawkish statement would add positive sentiment, would have more of a positive sentiment for the pound, a bullish reaction. A more dovish statement would lead to a more bearish reaction to the pound potentially. Then we have the vote too. So there's a three-pronged attack for the Bank of England. Okay, but just kind of before we kind of go through that, so the biggest currency that had a market reaction was GBPJPY. Today, because the Japanese yen is the strongest, you could see again Japanese yen being having the strongest market reaction out of the other currency pairs. Also to be aware of, you've got to keep an eye out on GP New Zealand dollar, but overall it has been, but last time around actually it was GP New Zealand dollar that had the strongest reaction. Usually it's been GBP JPY that's more or less had the strongest market reaction compared to others, but there's a mix between GBPJPY and the New Zealand dollar and Aussie dollar. The FTSE seen about 33 ticks down, and then it was up. It was down by 21, and gilts too for the long gilts was down by 61 ticks, and after about 10 minutes of trading, it was up by about 84. So GBPJPY and the GBP New Zealand dollar is what we're gonna keep an eye out for. But going back to the three-pronged attack. So the voting intentions too are also going to be quite key. Let me bring that up actually. GP, it's a D. There we are. I know somebody had questions in the chat. Maybe they did or didn't. But yeah. So the other point being is, so what you'd want then for is these figures here for the MPC. Vote here, okay, vote unchanged, hike, and cut to all be as expected, okay, because then you can focus on the statement and the rate itself. If the rate comes in as expected, then your focus shifts to the statement and what's being said by or what has been said by the Bank of England, whether or not they have decided to surprise the markets with a bit of commentary that adds downward pressure. But yes, no, it's all priced in. That's what happens when they have, that's what happens before a rate decision. Yes, you're right. PhD, Dr. Jean Anton. I got a doctor in here. Yeah, so yeah, whenever a rate decision happens, then traders try and speculate on where they expect the next, or what they expect the rate to be in the future, and then that sentiment then goes into the markets, and then traders will price it in. But yes, so any surprises that deviates from what's priced in is where the volatility creeps in. So that's what we've got to be cautious of. So the votes, if you do get, let's say, a member that joins, let's say green, who is on the neutral or who's on the fence, joins the vote unchanged, okay, being the new member, that could cause some extra downward pressure, could cause some downward pressure on the pound. Or let's say there are more members that start to go to the unchanged side, and they're less expecting for a vote hike. Again, that's another thing that could add downward pressure to the pound. Hopefully all comes in as expected. Hope it does. All right, 1 minute to go till the rate decision. Okay, let's get this baby going. Okay. Let's get our TICKSTRIKE ready. Okay. Let's get that out of the way with. Let's go there. Okay. Okay. Right, 10 seconds. Hike, 25 basis point hike, 25 basis point hike as expected. 25.25%. Okay, all right, let's go through this here. So I'm going to go sign up quickly. Okay, so we had House Cullen Man voted to raise by 0.5% to reduce risk of more costly inflation, more costly tightening later. All right, so how did the markets react to that? So the statement then, kind of a little summary then of the key points that were made. You had seen, yeah, no, I did turn the mic off. I did. So yes, I am back now. But traders see 68% chance of a 25 basis point rate increase at the September meeting after the Bank of England decision, and 32% chance of no change. They're not forecasting recession, but the risks of one are significant. So there isn't anything significant out here. They did. So the rate was as expected. They expect inflation, employment estimate, wage data to be higher than they had predicted before. GDP to be slightly better as well. Again, I think the key point being here, the June CPI surprised to the downside, but notes much less so for core goods and services. So the surprise point here, that's surprising the Bank of England to the downside, is probably what has helped keep or push the pound lower. All right, let's kind of see what else we have here. Let's go all the way back to the beginning. Haskell and Mann voted by raised by 0.5. Okay, so there might be a little bit of a shift here. So if some of the members, if I believe it was Ramsden, was also looking for a 50 basis point hike last time round, now that he's not one of those members, that might have been adding to that might have added to the downward pressure that there are less members looking for stronger rate hikes for the Bank of England. Also expecting inflation 1 year's time dropping by quite a bit as well would have helped, would have caused that the pound to take that hit as well. So other than that, nothing was surprising out of the rate decision itself. The market reaction you can see on the initial move was whipsawed, but now you're seeing a continuation of a downside movement here. So one of the things that we've got to remember as well, we have the Bank of England press conference with Bailey too at 7:30 a.m. Eastern time. So the link will be put out on the site here shortly. And then we'll give that out to you guys. All right, that concludes today. Well, that concludes not just that concludes Bank of England for today. What we have coming up next is we have Amazon and Apple earnings later on in the day. Well, aftermarket will have those earnings coming through. So let me get if you haven't subscribed or to the channel already, then make sure you do subscribe and hit that bell notification icon, and also like the video if you found the information useful as well. And that'll be good to help us always with your continued support. So let me grab the video up here for the earnings for later on today. All right. Okay, got it. Okay. All right, so that's for the earnings for later on today. So, FinancialJuice. What is it? FinancialJuice is a live voice and text service that gives you up-to-date, real-time news on how the markets are reacting and why the markets are reacting to if there is a certain headline that's come out from, let's say, Bailey or from Fed's Powell that's rocked the markets that you might not usually be aware of until you see it quite later on. Having a real-time voice and text service is quite key to your day trading experience. So what you can do, let me just show you the site here. Let me move TICKSTRIKE around so you can see everything. All right. So here we go. So you can see the feed here, the live voice and text feed. So you have your voice feed here. Okay. Again, all in real time. And then you have your news feed here of the text headlines that have come through as well. So the text headlines giving you an update news on what's going on what's been said by different people in, if it's a politician that says something. As I said, if Fed's Powell or Bank of England's Governor Bailey has made more hawkish comments than what traders might have expected, then that could rock the market. And then you'll know at what time that headline had come out, and then you'll be able to kind of marry it up with the market reaction, just like we had with the Fitch Ratings piece. Fitch Ratings downgrading the US from AAA to AA plus. That had caused a sell-off on for the dollar, and also the stock futures too for the US, because of that headline that had come out. The sentiment had shifted. So yes, news driven by fundamentals, and it's down to you and down to technical analysis as to what you see. But news drives the markets, and then the rest is history. So also on the FinancialJuice news feed, you get the economic calendar and data as well there live. Okay, so what we want to do is provide you guys with a 7-day free trial of FinancialJuice Pro. But first of all, let's kind of talk about, what your why. Let's kind of talk about if you're not ready to sign up for the FinancialJuice Pro version. First of all, what you can do is you can sign up for the light version here, which is there in the chat. The light version, basically, it's more or less the same, but the Pro version, the difference between the light and the Pro version, in the light version you have adverts that play, you have advert banners, there is a delay to the whole site, to the whole feed itself. That's including the voice, news, and the text, and also the economic calendar as well, on the data here on the left-hand side. Okay, so there's a delay, but it doesn't mean that it's not useful. So because the delay, if you're coming across the live voice and text service for the first time and you're not sure how it will work, how it fits into your trading day or trading strategies, then have a look, play with the free version. Sign up to the FinancialJuice newsfeed, get an account, go to your email, verify that email, go back, and then have a little play. And if it's something that you do want to buy and you do want to go to the Pro version and subscribe, that we can do is there will be a button here that says Go Pro. Make sure you have an account first before you go to buy the Pro version of FinancialJuice. If you don't have an account on the FinancialJuice account, then when you go to the Pro version, it makes it complicated to set you up. So make sure you have login deets for FinancialJuice. Click Go Pro, select the subscription that you want, then go to your email. Of course, just make sure the payment has gone through. Go back to the website and to the newsfeed here, log out, and then log back in, and then that will act as a verification. And then you should see this lovely site here that I have as well. Of course, you can change color if you want to. So that's the FinancialJuice newsfeed. Again, we've provided the link there for you to have a little play with. And one of the things to be aware of, so the deviation sheet. So if you're interested in finding out how to get your hands on the deviations, ranges and deviations for the economic releases, let me just bring it up here again so you can see what I'm talking about. Here we go. So deviation sheet here. Let's go to the Bank of England. Deviations sheet here. What I do is I tell you how the markets have reacted to the economic releases in the past. Okay, how big was the market reaction? What was the movement 10 minutes after the release? Okay, that's what the figure in brackets shows here. So this figure shows you how strong was the initial market reaction on a 1-minute candle Go to the wick of the candle, and then the figure in the brackets shows you the market reaction 10 minutes after the release has occurred, going to the end of that candle. Again, all on a 1 minute chart. And then also for economic, let's say for central bank events, or for all central bank events, most of them, you would get a paragraph or box talking, a sentiment box here, talking about what caused the move in the markets, what did the central bank say that made that move occur. Okay, that's also provided in there. So this, if your next question is, well, how much do you have to pay? Show me the money. It is completely free. No charge for it, and you get access to this in live real time with if you're a subscriber to the MacroAce MacroAce main list. So let me just get that up here for you. So I'll grab the link here for you. MacroAce main list. There we go. So not only in the main list do you get the details of you get access to the sheets for all the different economic releases, but you also get a little summary of what to expect for the week ahead. What I mean by that is what are the economic releases to focus on, or what is the news that's kind of come through in that session. That's been quite that could be important. But it's short. It's a short summary. It's not big chunks of text or information or bar graphs or bar charts or anything like that, or line graphs, because I explain more of the detail about the economic releases and the sentiment surrounding the markets here with you guys in these live streams. But that's MacroAce and TICKSTRIKE. So if you're not familiar with what TICKSTRIKE is, TICKSTRIKE, what it does is it allows you to list order flow within the markets, okay, in different assets from stocks, forex, crypto, ETFs and ETNs, futures, and your internals as well. So there's different things you can focus on with TICKSTRIKE. Or another way to put it is it shows you how strong the buying or selling momentum is within that asset or asset classes that you may be looking at. So if we're all looking at the pound here, or the currency pairs, or all with the pound, you can kind of monitor the overall strength of the pound and how it's performing, how strong is the buying or selling momentum. So there's different ways that you can use. You can focus on one. Maybe if you just want to focus on a couple of assets or a couple of bits within those asset classes here and there. You can do that, or you can look at a range or all different assets to see how they're performing within the markets to kind of give an overall view of how strong the momentum is. So again, another way to put it is how strong is the buying or selling momentum within markets. So this figure here shows you with the plus symbol shows you the buying momentum, and then the minus symbol shows you the selling momentum. Okay, the figure here, number 1, basically shows you the sensitivity level of what we call here the ticker box. How often will it give you an alert, basically, depending on the strength of the buying or selling momentum. Okay. So 1 being the most sensitive to market reactions. Whenever you see a lot of buying or selling momentum, as you can kind of see there, then TICKSTRIKE will pop off. The higher you raise that level all the way to 15, 15 is the least sensitive to market reactions. So when there's only a big amount of buying or selling momentum that occurs, does TICKSTRIKE pop off compared to what it is, compared to that asset that you're looking at that current time. Okay, so that is TICKSTRIKE there. So again, there is a 7-day free trial of TICKSTRIKE as well, which I'll post out in the link here for you in the chat. And there you go. That is there for you. All right. Okay. So that's basically it for you. Oh, one more thing as well. Apologies. So we have unusual activity. So if you like trading high probability stocks, if you like trading high probability in stocks, futures, FX, and crypto breakouts in real time, then you can do that with unusual activity as well. So I'll put them in the chat too. There are a lot of links. There you go. Right. Well, ladies and gents, thank you very much for joining me live for MacroAce. I will catch you later if you want to join me for Apple and Amazon earnings later on in the post the US session. For now, take care and have a wonderful day.